Thanks for coming back to Fireside Chats with Dennis. Hey everybody, Dennis LaVoy with Telos Financial, Michigan's financial advisor for young professionals. Thanks for checking out my video blog today, appreciate it. Today I'm going to talk about one of the more common questions I get. If I have extra cash flow and I have loans, should I aggressively pay down those loans as possible, or should I do savings or do something else with the money? As I always say, you should always consult your financial professional. Everybody's situation is unique, but today I'm going to talk about a few reasons why it might make sense to look at options with this. I'm going to talk about three things. One is the behavioral effects, two is the time factor, and three is liquidity. So number one, behavioral. Let's say, for example, you have $400 extra a month, and you have student loans, you have mortgage, you have car payments, whatever that debt is that's bothering you. If you take that $400 and, for example, you save $200 and put $200 towards loans, you have that $200 already going to savings. So once those loans are paid off with that other $200, at the end of it, you're probably not going to stop that savings. You've set it up. It's something you've been doing for a number of years at this point. So that'll continue. You're less likely to be susceptible to lifestyle creep, where you would take that full amount and just spend it. And lifestyle creep is where your lifestyle adjusts to your cash flow. It sort of helps hedge against that. So that's reason number one. Reason number two is time. Time is one of the biggest assets you have on your side, if you have it on your side, as an investor. If you're young and you have time until you need the money, that's a huge benefit to you. Time lets you recover from market bumps. It lets the markets average out, which historically they've averaged to pretty strong returns. Looking at the S&P, if you looked at 1937 to 2017, a 90-year period, the S&P averaged 10.4%. It was up about 3/4 of the time. 77% of the time it had a positive return for a calendar year. So the statistics are sort of in your favor. In a hypothetical situation, let's say you got 7% return. You were in sort of a moderately aggressive portfolio, moderate portfolio. You were able to get 7% return. And in this example, let's say you graduate college, you're 22, and you have $400 a month, like I was saying, roughly, or $5,000 a year. So let's say you invest $5,000 a year from the time you're 22 to the time you're 31. 10 years at $5,000 a year. A total investment of $50,000. At 7%, by the time you're 65, you would have about $737,000, a little over $737,000. It's a great return, right? Alternatively, let's say you take that extra $5,000 a year and you dump it into loans for those 10 years. Then at the end of the 10 years, now you start investing that $5,000. You don't give into lifestyle creep, now you start investing. Same 7% return from that 10-year period to the time you're 65. In this case, you've invested $170,000, but now at the time you're 65, you'd have $686,000. $51,000, about $51,000 less. So it's a pretty big difference, and it's a much smaller investment. In the first scenario, of course, you're taking on more risk. You're paying more in interest expense, right? Because you're carrying the loans longer because you're investing rather than paying down the loans. But at the end, if you're willing to take on that risk, you can see the benefits. And again, it's not right for everybody, but if you have the risk tolerance, if you have the time, it's an illustration to show you the benefits. And the third reason is liquidity. We recently went through a big government shutdown. It was widely publicized. There were a lot of stories I heard about folks that, they missed 2 pay periods basically, and they didn't have cash to make it through 2 pay periods without getting paid. I think the number is 80% of Americans don't have that sort of cash. One of the core fundamentals of financial planning is having an emergency fund. That's, you're talking months. That people don't even have 1 month. So if you don't have that liquidity, if you don't have an emergency fund, having some of those funds saved for an emergency fund is another reason, just liquidity. So again, 3 reasons. If you have extra cash flow and you have loans, it might make sense to save some of that or invest some of that cash flow rather than aggressively paying down your loans. Behavioral, time if you have it, and liquidity. Thanks for watching today. It's Dennis LaVoy with Telos Financial, Michigan's financial planner for young professionals. Check out my website for more information. Call today to set an appointment. I look forward to seeing you next time.